Many retirees are shocked when their Medicare premiums suddenly increase, sometimes by hundreds of dollars a year. What most people don't realize is that certain withdrawals from retirement accounts, like IRAs or Roth conversions, can quietly trigger higher Medicare premiums. This rule is called Irmaa, and it surprises people every year. After working with Medicare clients for years, I've seen this happen far more often than people expect. In this video, I'll explain exactly how this works and why it happens. When you enroll in Medicare Part B and Part D, most people pay a standard premium, but Medicare can charge higher premiums if your income exceeds certain limits. This additional charge is called the Income-Related Monthly Adjustment Amount, or IRMAA. Here's the part that confuses many people. Medicare doesn't look at your income this year. Instead, they typically look at your tax return from 2 years ago. So the income you reported in the past can affect the Medicare premiums you pay today. Many retirees assume that withdrawals in retirement won't affect their Medicare premiums, but certain types of income can increase the amount Medicare charges for Part B and Part D coverage. For example, things like withdrawals from traditional IRAs, Roth conversions, large capital gains from investments, or selling property or other assets can all increase your taxable income for that year. Medicare typically reviews your tax return from 2 years earlier when determining premiums. Even if these financial events only happen once, they can temporarily push your income into a higher IRMAA bracket. When that happens, Medicare may increase your premiums for a period of time, even if your income later goes back down. Here's a common example. Imagine someone retires and decides to withdraw $80,000 from their IRA to remodel their home. That withdrawal increases their reported income for that year. 2 years later, when Medicare reviews their tax return, their income appears higher, even though the withdrawal only happened once. As a result, their Medicare premiums may increase for that year. This surprise catches many retirees off guard. The reason this happens is because many people plan for taxes in retirement, but they don't always realize that Medicare premiums are tied to income as well. Financial decisions that seem unrelated to Medicare can still affect what you pay for coverage later. Understanding how income affects Medicare premiums can help you avoid unexpected costs. This doesn't mean you should never take withdrawals from retirement accounts, but it's important to understand how those decisions may affect your Medicare costs. Planning ahead and being aware of the income rules can help prevent surprises later. And if a life-changing event affects your income, such as retirement, divorce, or the loss of a spouse, there may also be ways to request a Medicare review. One thing many people don't realize is that Medicare premium increases aren't always permanent. If your income changed because of a life-changing event, such as retirement, divorce, or the loss of a spouse, you may be able to request a review. This process is called an Irmaa appeal, and it allows Social Security to reconsider your Medicare premiums based on your current situation instead of older tax returns. Not everyone qualifies, but it's something many retirees aren't aware of. Medicare rules can feel complicated, but understanding how income affects your premiums can make a big difference in retirement planning. If you found this helpful, subscribe. I share straightforward explanations about Medicare so you can avoid costly mistakes and make confident decisions as you approach retirement.